Welcome, everyone. Henry Wheelwright, managing partner and co-founder of StablePoint Partners, doing our Friday video, checking in with our clients, general audience, and of course, want to acknowledge it has been quite a week. If you feel like you've been on the roller coaster, a little bit nerve-wracking, a little dizzying, we completely understand it. This has been a unique set of trading days, and of course, a lot to digest for investors. Our job is to always educate clients, be here as financial planners. So I wanted to really piggyback on last Friday's video from my partner, Chris Griffith, to talk about our guidance, but also what we've learned from previous pullbacks, previous bear markets, and more importantly, periods of time where volatility really spikes and it feels like you need some guidance. So I wanted to start out first with the week's news. It's Friday morning. We are coming into earnings season. I'm going to start with that before I talk about the tariffs. We've heard from some major banks and major investment firms, most notably JP Morgan this morning, Morgan Stanley. Both sets of earnings have been incredibly strong, excessive returns and revenue on trading, which has come to be expected. Did talk about the strength of the consumer potentially weakening as a result of tariffs. But overall, Jamie Dimon did a nice job of saying, hey, if we can get some resolution, some clarity around tariffs, the overall backdrop, not only in the banking sector, but the general US consumer is still in pretty good shape. Obviously, that has a big question mark depending on how quickly we get some resolution to the current tariff negotiations. The other thing that no one talked about yesterday on Thursday, which is critical as it relates to interest rate policy in the Fed, we had a CPI number, Consumer Price Index number, which really has been closely looked at to judge where inflation is now, potentially where it may go, also associated with tariffs, and the implications for the Fed. So we came into this week after the harsh selling last week with an escalated probability of Fed rate cuts, something I think investors are thinking about, but maybe not truly focused on. We have a history of equity returns being very strong when the Fed is stimulating the economy. We are looking at a 100% chance right now of a Fed rate cut in June. And we've gone from potentially just 2 Fed rate cuts to as many as 3 or 4, depending on what's happening with the consumer, the labor market, and tariffs. So one certainty is it's going to be uncertain for a little while. I wish I could tell the clients on this call that next week the market's going to have a V-shaped recovery. The probability is it's going to take a few months for this to play itself out. The big news this week was the pivot by the Trump administration. We all expected the additional tariffs across many countries to come into place on April 9th. What in fact we saw was a 90-day moratorium for the majority of countries. We still have a 10% tariff on all imports. The remaining auto, steel, and aluminum tariffs remained. But generally speaking, the current administration has bought some initial time. There's been lots of discussions that over 75 countries are currently in negotiations. And on the flip side, we've seen China and the US really escalate the tick for tack reciprocation. Both countries, as early as this morning, raising tariffs up in the 125% range. And clearly, this is a demonstration of the previous trade wars back in the first term for Donald Trump in 2018, where China is really going to be the focal point. What does StablePoint take away from it? Chris did an excellent job last week talking about context of volatility, diversification, not concentrating portfolios to the S&P 500. And I think the message really hasn't changed. If you look at where a lot of the pain points have been, they've been focused on those Magnificent Seven, those highly concentrated growth technology names that made up a third of the market. It's the area of the market that has the highest price to earnings multiples, and also our particular companies that could be in the way of growth projections based on some of these tariffs. So being spread out, not just in liquidity measures like short-term bonds and cash, having fixed income for the clients that have owned precious metals, and then being balanced in your equity exposure and utilizing private investments. That's still our message for anybody that really wants that balance between some growth and income, but also capital preservation. I think specifically what has changed in my mindset is the discussion around a recession. We've seen a lot of major firms, including Goldman Sachs, move up or down their targets of probability on the recession, just alone on the president's comments on Wednesday. His comments caused a historic rally in the market, biggest rally that we've seen since 2008. Technology shares, many companies went up 20% on the day. And it pointed out a few things that I look at from my 25 years in the business. The first is this is likely an event-driven bear market, meaning all the major indices had a 20% retracement. And event-driven bear markets often are shorter in duration, but still very painful. If you look at the chart that I'm going to bring up on the left, we try to categorize three different types of bear markets. The event-driven bear market that is typically an 8-month period of time to go peak for trough, meaning before clients really recover in the markets, sees that 29% drawdown, which would really be in line with what we've seen in a lot of growth companies and very close to some of the major indexes here in the US, like the NASDAQ. But often those event-driven markets have more of a U or a V-shaped recovery. I'm going to bring up a slide in a bit that's going to show you the COVID era. This reminds me a bit of that type of shock to the system in which we have an uncertain outcome of significance that can cause a recession. But ultimately, when we start to get clarity and resolution, the markets recover. So event-driven shocks are where we are now. I think there's been a lot of reasonable and academic discussions about the longer we have this uncertainty or the erosion of capital spending, confidence, or ability for publicly traded or private companies to plan their year as a result of tariffs, we can go into a shallow or more cyclical bear market. That's that next drop down on the list. If you look at the months of recoveries, that tends to extend out from just 8 months to 25 months, has that similar 30% drawdown that would go in line with a lot of these growth companies or Magnificent Seven companies from their previous heights, but tends to be much more of a systemic shock that then leads into a longer period of a recession. We have a 45% probability at Goldman Sachs of a recession. They're starting to push those numbers down. If in fact this moratorium of 90 days provides opportunities for the Trump administration to actually get some wins on rollbacks and negotiations, but clearly that is a remain to be seen environment. I would expect it to be choppy for the next 90 days within the market. I think we are not going to have a structural bear market or something more in line with what unfortunately we went through in 2008 and 9, where you have a multi-year period of time in which you need recovery, where your drawdowns can be excessive. Sure, that's a probability. I think the only scenario that would be quite premature to say now is if we had more permanence on both the tariffs and an enclosure around trading and global trade, the probability for a longer, more severe recession remains on the table. I don't think that is likely. I think most investors should think about volatility the next 2 to 3 months and then look at some statistics around trying to time the market. The next slide that I'm going to bring up really shows the best 50 days in the market and the worst 50 days in the market going through a period of time that includes some of these structural shocks and bear markets. And you'll notice that some of the best 50 days and worst 50 days are clustered very close together. This is why often financial professionals, much like those at our firm, talk about the real challenge of trying to time the market. For those that have looked to take opportunities and buy some of these heavily hit technology names, I think you need to look at your time horizon, look at the opportunities to not perfectly time your entry point. And I've said to many clients that the next couple months, you really need to have a dollar cost average approach. But buying into this market certainly makes sense based on the historical returns, but you need to keep in mind that it could go a bit lower before higher, and it's almost impossible to time the market. For those which fortunately we haven't had that are looking to exit the market, if you have liquidity, if you have fixed income cash, and you have the ability to withstand some of this volatility, it is much more probable that because of midterm elections, internal political pressure from House Republicans, pressure from Wall Street business leaders, that negotiations will be front and center and be a key dialogue with the current administration. And I still think that's quite probable, even though it feels very unsettling and uncertain at the moment. I think the last slide that I'll bring up goes year by year, all of the bear markets going back to 1929, when we had, of course, the Great Depression. And you'll notice on the left-hand column, we talk about these types of recessions and bear markets that we've been through. There's the event-driven shocks, right, that I think we're in right now. There's those cyclical bear markets. And of course, there's the longer lasting structural bear markets, much like we had through 2007 and 2009 as a result of the banking crisis and housing crisis. What you'll notice in the column of drawdowns is it's always very painful and it's often very sharp, like what we've experienced. So I think that is normal. It's normal to be unsettled and uncomfortable. What you'll notice is in the column of where the market begins to recover, 6 months, 1 year, 2 years out, you see some incredibly robust and strong equity returns. And one of the comments that I thought was very poignant from our research analysts is this week, when you look at the major retail outfits and discount brokers, the vanguards of the world, they've seen consistent flow into the stock market. What that tells me is there's a lot of muscle memory built up from COVID. Anybody that went through our last event-driven shock and was brave enough to continue to invest was handsomely rewarded for being consistent and putting capital to work. So my message to the StablePoint clients is as follows. Obviously, our team is here for you. Our 4 financial planners want to sit down, talk about plans, be front and center. We realize that there's only one Henry, one Chris, one Kenan, one Claire, but our real goal is to make ourselves available for those discussions. But staying invested, understanding your plan, perhaps rebalancing, and for those that have had capital, we can talk a little bit about where to deploy. But our mindset is it's always darkest before dawn. We've seen these environments before. We want to keep our head when others won't. I think historically speaking, but also living in the present moment, there's a lot more probability that we're going to have some very strong returns when tariffs are not front and center. So we appreciate the trust and confidence, wish you the best, and hope you have a great weekend.